Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to the LiveSquawk Market Talk weekly review. This Friday, the 19th of December, 2025. This will be the last episode of the year as we break up for the Christmas festivities. In terms of anyone new to the show, this is where we break down the key stories of the week gone and the implications for the markets. We'll also take a look at the week ahead, and we'll try and give you a heads up to what you should be looking out for. In this episode, I'm joined by regular contributors and friends of the show, Ryan Littlestone of Forex Analytix, and Michael Brown, market analyst at Pepperstone, the spread betting, CFD and Forex trading platform. But before we start, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And with that, I'd like to wish my two guests a warm welcome and a Merry Christmas, if I'm allowed to say Christmas anymore, and festivities.
Well, I'm not going to tell you off for saying Christmas, mate. A Merry Christmas to you as well.
Yeah, Merry Christmas, mate. Thanks for having us on again.
Thank you, guys. No, as ever, it's going to be entertaining. Right, we'll crack straight on them because there's been quite a lot out this week to get our sort of teeth into. We'll start with the most boring of them, just to build this. The ECB interest rate decision that was out yesterday. We got a hawkish hold that kept the deposit rate at 2%, and updated forecasts. Mike, I'll start with you. Anything from yesterday's event that really caught your eye?
Apart from a certain journalist being present at the post-meeting press conference, no, absolutely not. It was a bit... Well, I wouldn't call it a damp squib because it was exactly as expected. You know, the ECB standing pat, Lagarde saying that policy is in a good place. I guess, and I am sort of slightly scraping the barrel here, but maybe the most interesting aspect was that they held the 2028 inflation projection at 2%. So that was potentially going to be a source of ammunition for the doves into next year. If you're forecasting an inflation undershoot for 3 years, is that an argument to deliver another rate cut in 2026? That's now obviously not the case, but I really think it's a case of, you know, as you were, the ECB are done and dusted, and they're just going to hold rates at 2% for the foreseeable future, I would expect.
Yeah, I mean, there was a sources piece out after the meeting itself that said this is it, they're done now for rate cuts. You know, how true they can say that is yet, I don't know, but they seem fairly the official that gave the interview seemed fairly certain that was it from the ECB Governing Council. Ryan, anything you can hang your hat on from yesterday's meeting?
Yeah, well, apart from Lagarde's outrageous outfit wearing a tea towel over her shoulder and a dead bird skeleton as a brooch. Yeah, I mean...
Are we getting sartorial now? We're looking at the sartorial.
Well, we always used to look at Draghi's tie for a policy signal back in the day, didn't we?
We used to bet on Draghi's tie.
Yeah,
exactly. But yeah, apart from that, I mean, you know, they've been telling us that growth has been resilient, you know, and there's reasons to be positive. I mean, they upped 2026 growth by 0.2 percentage points and 2027 by 0.1 percentage point. That's not exactly booming territory. It's in the, you know, the low 1.4s, 1.3s, that sort of thing. So if that's a boon for keeping rates on hold, it's a very, very low bar in my opinion. As for the rest, yeah, they didn't push back really against this hawkish pricing that's generally picked up around a lot of central banks at the moment. So that was a bit of a surprise because, you know, the ECB are all about making sure their message is heard and adhered to. But then in one sense, if they allow a bit of market tightening, that helps with any inflation pressures and does the cutting for them, so to speak. So, but overall, yeah, they're going to be on hold for a while, but I don't think they're out the woods regarding growth. I think if things are weak into the new year, I still maintain that that's going to cause some disinflationary pressures, and then they'll probably need to cut rates again to try and stimulate the economy rather than combat inflation.
Well, there's going to be a big inflation undershoot in the first sort of 3-6 months of next year anyway, because of the base effect you get from energy. So it's more, it's then a question of, do they look through that, or do they actually say this is a more structural problem of low growth, or it's a statistical quirk? It's which side of the coin they come down on that front.
Yeah.
I mean, I asked the question yesterday, just briefly before we move on, where this hike talk came from. I mean, yes, obviously we got the German stimulus, but that's over a number of years. It's spread out over a number of years. We've still got a war on the doorstep of Europe as well, the Ukraine-Russia situation. And whereas China was once a customer, it's now becoming a competitor. So there's a lot of headwinds out there, really, for the European bloc, and I don't know. From my perspective, I just think that they've always sort of flirted this disinflation, and yes, it's steady at the moment, but you don't know where that might turn. But
well, I think it was just really clunky communications, because the next move is a hike could mean you're going to hike at the next meeting, or it could mean you're going to hike in 3 years' time. I think Schnabel didn't do a particularly brilliant job of actually putting a time frame on that. I mean, I would happily stand here and say I think the ECB's next move will be a hike, but that's a story for like the back end of 2027, early 2028. The only reason I'm saying that is because I don't think they're going to cut anymore. So I think the market sort of heard the first part of that headline and just ended up running away with itself a bit.
I think also that it actually started, I think, back with the Canada data, Canada CPI, and the market started pricing in hikes over there, and then we got Schnabel out. I think it was in that order anyway, and that really got the ball rolling. I mean, this thing's only started happening in the last 2 weeks, and the market's always forward looking, and it's thinking, right, well, if a lot of these central banks are at their preferred neutral level or close to, then the only other direction is going to be up, or the next direction is going to be up, and it's really just spread around a lot. But as I say,
which tends to happen.
It looks ahead.
You do get that from time to time, I guess. With these markets.
But they're not how far it goes.
They're not going to hike rates when they're undershooting their inflation target. If anyone actually believes they're going to hike next year, then I've got a few bridges I'm happy to sell you.
You must be running out of those bridges, Mike.
Well, I keep getting people to build new ones after selling them so quickly.
He's good at the old Lego.
It's a profitable business at the moment, it would seem.
Indeed. It's the only growth industry in the UK.
If only that was a lie. Bank of England interest rate decision, not so dovish cut. Yesterday, for anyone who wasn't aware, we saw a narrow 5-4 vote in favour of a 25 basis point rate cut to take the rates below 4% to 3 3/4%. Bailey was the pivot, moving from the Hawks to the Doves side of the fence yesterday, but wary really of signalling further cuts too far into the future. But they didn't rule out further lowering of borrowing costs, but for the time being, this is where we're likely to sit. Again, we'll start with Ryan this time. Ryan, what did you make of it?
Yeah, I think as you said, it wasn't a dovish cut. I was a bit surprised by that vote count. I thought it might have been a bit wider towards the cut side, purely based on that CPI data. But
you weren't alone, by the way. That was the general feeling.
Yeah, exactly. But I think that came about because obviously they're going to do the old usual, well, we're not going to be swayed by one number type thing. There was a dovish step towards it, like they're going to continue cuts. Certainly their comment on the budget that it's only going to bring 0.1 and maybe 0.2 percentage points to growth is not exactly, again, really bullish. So that keeps things on the soft side. I think they are more likely to continue cutting rather than stand on hold now. But we've got to wait to see what the future data brings. And the question is now, where do they get rates to? And that was one of the things Michael pointed out yesterday. The market really may be implying that they're only going to cut once, maybe twice more, and I think that's going to be wrong, because there's still nothing in this economy that suggests anything's going to pick up anytime soon.
Yeah, just on that note, there was pricing that we would like to get 2 more cuts next year. Well, from a couple of banks I read anyway. So there was some of that pre yesterday's decision, but yeah, it's definitely. I don't get, like you, the situation that they think they're confident enough that growth won't slip any further. And if growth does slip, then obviously that potentially pulls down inflation as well. And we've just seen a big pullback on the inflation side a pullback on the inflation side. Mike, what are your views on yesterday's decision?
Mate, I don't know what they're doing. And actually, I don't think they know what they're doing, to be completely honest with you. I fully agree with everything you've just said. And actually, the bank are now not at risk of falling behind the curve. I think they are massively behind the curve already. We've got an economy that's had no growth since the summer. We obviously had this much cooler than expected CPI number this week, and you've got the governor running around on television saying, we think we're now going to be back at the 2% target next spring, which is a year earlier than they forecast in the November NPR. And of course, amid all of this, the labour market continues to, basically fall off a cliff. I mean, unemployment's at 5.1%, and we've lost jobs in 12 of the last 13 months. So you read the comments in the minutes from those 4 hawks who voted for policy to remain unchanged, and it's almost like they're looking at a completely different economy, talking about upside inflation risks and earnings pressures and all of this sort of stuff. I mean, I think the BOE just need to get to neutral, which they reckon it's 3.5. It's probably lower than that, if we're being honest, and just sit there and get to neutral as quickly as you can. And I would not be at all surprised if the data does force them into another cut as soon as the February meeting, because as you two have both said, we're not going to have this massive turnaround in growth, or I'd be very surprised if we did. I don't think we're going to get a big resurgence in inflation, given the demand side of the economy is slowly being destroyed. And I don't think the labour market's going to sort of miraculously improve over the winter. So all signs point to the bank having to cut further. I guess the interesting point will be, what is the trigger for these 4 hawks who seem to be sort of stubbornly holding out against any rate cuts? When are they going to join the party and vote for some rate reductions?
Yeah. I mean,
because at the minute, the MPC is basically Andrew Bailey, because you've got 4 who are going to vote for a cut at every meeting, 4 who seem resolutely set on standing pat at every meeting, and it's basically, what does the big man want to do?
Yeah, that's probably why they had that language that further cuts will be a close call.
Well, it can't be a closer call than 5-4.
Exactly.
This is what I mean, where they're just tying themselves in knots now.
Well, I guess, look, listen, as you said, when we're pivotal around the neutral rate, and I've read places 3% potentially, really, to 3, like you say, 3% to 3.25%. You do get this conflict within the committee. We've seen it in the US. We're seeing it now with the Bank of England. We've seen it with the Bank of England. I mean, there's some that haven't wanted cuts for a long while. So I understand it from that perspective. But like you say, the outlook doesn't suggest that they should be stopping anytime soon. And I think Deutsche Bank have said that they still expect quarterly cuts into next year. So a pace of quarterly cuts. So
I mean, they were never going to do it, but you could actually build a reasonably resilient case for them to have cut 50 basis points yesterday.
Oh, that's bold. Yeah, they're not going to do it, but
they wouldn't have done it. But the data actually would support them doing it if they explained it properly. We've made faster progress on inflation than we thought we would. The budget risk is out of the way. The labour market, the slack is emerging in the labour market more rapidly than we expected. We need to catch up.
Yeah, I don't think they could have done that just on one CPI report that dipped significantly when it's been a slow process all the way through. If we get the same again next month, right, they might have a case.
But direction of travel was there. I mean, and if we're seeing cooling inflationary pressures, internationally as well. Getting ahead of the curve would probably not be the worst thing in the world, but yeah, it's contentious anyway within the MPC, as you say. Right, I want to move on to we recorded this on Friday. Bank of Japan interest rate decision. They actually came through and did what everyone thought they were going to do, and hiked rates to 0.75% from 0.5%. Would you call it a hawkish hike, Mike?
Well, I think I would, but it would be quite nice if someone would tell the yen that it was a hawkish hike, because dollar yen's about a big figure and a half higher than it was pre-decision. It may have moved even further while I've been off the desk. But yeah, I mean, obviously, everyone's talking about how the policy rate's now at a 30-year high. I mean, that 30-year high is still 0.75%, so don't get too excited. I think probably the biggest takeaway was Ueda at the press conference, where he was talking about how there's still, in his language, was some distance from the bottom of the range of estimates of the neutral rate, which suggests that, obviously we know tightening is going to be a very sort of slow and steady process. I think we're talking about potentially 2 hikes over the next 12 months, which is glacial at best. But Ueda is not standing there saying we're getting near the end of the tightening cycle. In many ways, he's saying we're still quite near the beginning of it. So I am quite surprised by the market reaction that we've seen, if I'm being completely honest, because it was the prior guidance of we will hike if the outlook is realised. That was maintained, but Ueda are also giving scope for potentially more interest rate increases than market participants have been expecting. So, yeah, I don't know quite why the yen hasn't got the memo on that, but my good friend Ryan was awake at 2:30 this morning watching it all unfold.
Yeah.
Glutton for punishment
and what
over
was
there.
your opinion? Yeah. And what did you make of it all then, Ryan?
Yeah, you've got to remember that these guys, they're not like other central banks. They're not going to say, okay, we're on a hike cycle and every meeting's live and that sort of thing. So in terms of the BOJ, it was neutral. It wasn't hawkish per se. Yes, the door is open for further cuts. No timeline. The progression towards their outlook, which, remember, their outlook is for the second half of fiscal year 2026. You're talking, the first half of 2027 for this outlook. It's a slow grind, and the fact that there wasn't, how should I call it, normal central bank type hawkishness from them is why we're seeing the yen weakening. I mean, this was always going to be the path that the yen was going to take if there wasn't anything massively hawkish out of them. I think we're well into intervention mode now. As Michael says, we're up through 157 now. So what we are up over 1.5%. So that yen index is going to be dropping likely through 75, which was the trigger last time when they intervened in 2024. I think if we're trading up at 158 or over, we are banging intervention risk mode. But and that comes even while they could hike. I think another hike is possible in Q1 next year. Depending on what inflation does. They still expect inflation to pull back under 2% on this cost push easing thing that they're talking about. But if it doesn't, then I think they could go again in Q1.
Well, I think the other point in terms of intervention, and I almost don't want to mention the word because it sort of tempts fate at this time of the year when we all want to bugger off and enjoy Christmas. But one of the things they love talking about is the currency moving out of line with the fundamentals. Well, the BOJ delivering a rate hike and the yen weakening well over 1% is about as out of line a move as you could put in a textbook, to be honest. So the ammunition's there if they wanted to do it.
Yeah, absolutely.
Fair point. I've got a note here from Capital Economics, Abhijit Saraya, that says, when the Bank of Japan delivered a much anticipated 25 basis point hike at its meeting today, it signalled a willingness to tighten policy further. With wage price dynamics set to remain favourable, we expect the bank to ultimately raise rates to 1.75% in 2027. So, I mean, we still have a fair amount to go, 100 basis points more, if that forecast is true, to go. So, and we know how painful and protracted the BOJ can make it when it comes to rate moves. So, it'd be an interesting one to watch on that front. And like you say, we'll wait for the yen to catch up. Right, moving on to the US, North America now. We got non-farm payroll. Normally it's top billion, but in this instance, with everything that's happened, there's a lot of, I guess, we still have to work our way through the good data and not clean data at the moment. So not bad, but not great either. I've said, because they released October and November. Reading November October from the data they had was poor, but we did see a decent rebound in November again, if you can believe the data, if it's clean enough for you. Who should we go to this? Ryan, what do you make of what did you make of it?
Yeah, I didn't think it was as bad as the market initially reacted. I think the market reacted on that unemployment rate number going up, but that there was also a rise in the participation rate. And if you just basically look at it from between September and November, you can tell the difference, because October we didn't get any of that sort of stuff anyway. So I can see why the market did get a little bit down on that number, but the October number was down, I think, 105,000, but there was a loss of 162,000 or 165,000 government jobs, and private payrolls actually rose 52,000. So if you look at October, November together, there was 52k gain in October and the 64k gain in November. So that unemployment rate also could have gone up just on the furloughed workers. A bit of a lag there. Yeah, it was a bit messy. But overall, I saw that data as pretty much what we've been getting before the shutdown. Positive numbers, double digits, not triple digits, and unemployment sort of creeping up a little bit. I don't think there's any worries yet that employment's going to fall off a cliff just yet, but we wait to see what happens.
Mike?
Yeah, I think I sort of broadly agree with that. I don't think we learned especially much new in terms of the jobs report. The US labour market is still quite clearly stalling out. I'm not quite as optimistic on the November print as I think Ryan probably is. But when you actually dig into, well, two things. Firstly, when you dig into the details of it, the entirety of the 64,000 jobs that were added in the month came from the healthcare sector. So if you take that out, there was actually no job creation at all. And also, of course, you've got Chair Powell saying, well, actually, payrolls might be overstating things by 60,000 anyway. So again, you've got to sort of skew things lower. But we kind of assumed that the US labour market was stalling. Hiring is very, very slow. The pace of layoffs is very, very slow as well. And I think there's absolutely nothing in there that's going to deter the Fed from continuing to remove policy restriction and continuing to lower the Fed funds rate into next year. I mean, obviously, we get the December jobs report before the January FOMC. That will, of course, be one to watch very, very closely. But yeah, I think it's very much that same story of the US labour market is just kind of muddling through at the moment. The other point I'd just make lastly on this, obviously unemployment at 4.6%, not only was that a cycle high, it's also above the median forecast for the end of the year in the December SEP, Summary of Economic Projections. So that's just something to bear in mind. The question then is the labour market weakening at a slightly more rapid pace than the median member of the FOMC expected? If it is, if we see a further rise in unemployment in December, then again, that strengthens the case for a January cut.
I think with all the cloudiness and the government shutdown, you can forgive maybe some of these members for not having the full picture to work with at the moment. So, I guess the next round of projections, the next SEP, should be a better point of reference for where members are. Just quickly then, on US CPI, cooling faster than expected. A tame in US inflation print gives the Fed room for more rate cuts, says ING, following Thursday's release. I think it was yesterday, wasn't it?
It was yesterday,
yeah. Mike, but again, combine it with what you've just seen with the job stuff. What do you make of the CPI?
Well, I mean, if we're talking about cloudiness and data that we shouldn't read too much into, I think CPI is a great example of it, to be honest. Obviously, much cooler than expected, 2.7 on the headline, 2.6 on the core. There's a number of issues with this, and I think again we need to look at the December number to see whether is this a one-off, is this a statistical blip, or is inflation really cooling much faster than we expected? The two big issues that I've got with the CPI report is firstly the BLS obviously collected no data in October, so they effectively had to guess what prices were doing that month. And one of the things they did was they put rent inflation in at 0. So basically rents didn't move in the entirety of October. Well, clearly they would have done. And we know shelter costs are a huge bit of the inflation basket. So that will have dragged the headline metric lower. The other thing is that they will have collected all of the pricing data in the last 2 weeks of November, which is all around the discounting season with Black Friday, Cyber Monday, etc., etc. So that's probably skewed things a bit lower as well. It's good data if you just take the headline numbers. I just don't think we should be popping the champagne just yet, and we need to wait for another month or two of data to see whether this is a quirk or whether the US economy is actually making progress back towards the 2% target again.
Yeah, good points made there, Ryan. How did you trade it? Did you trade it? Was it something you used as one of your sort of points of reference?
Yeah, I didn't trade it. I had some levels that I was keeping an eye on, but we never got there, so I left it alone. But yeah, I agree, Mike. The initial reaction from everyone was, "Oh, blimey, that's a soft one," and then you have to wait for the details to be dug into. And yeah, it's because it's such a mess, and you can't really trust it. I think you've almost got to ignore it. And I think the same thing is going to happen today with the PCE if it shows similar. Yeah, we need to get a proper fresh month of data to see what goes back into it, what doesn't go back into it, whether these numbers are real or not. So I'm not trusting it one little bit.
Well, I think the market reaction yesterday was really telling because, as you say, there was that sort of blip. Treasuries rallied very briefly and then paired all of the move. And everyone you spoke to, on the floor, you kind of get the data and you just go, that doesn't look right. It almost doesn't pass that sniff test straight away. And then you start digging into it and working out what's going on. So, yeah, I think, if the December numbers are 2.7 and 2.6 again, we're going to have a very, very different conversation next year and say, green light for Fed to cut in January and probably March as well. But let's wait and see what that says.
Yeah, let's be honest. Again, with the incoming Fed chair, apparently a dove already, it kind of gives a game away anyway as to where we can see direction of travel for US rates, irrespective, I think, in some aspects of data. So it'll be interesting. Just very quickly before we wrap up, a quick look at the week ahead. Obviously, shortened week. You have festive holidays, Christmas Day next week, so very little out. Markets are probably shutting down now. In all honesty,
isn't Ueda meant to be speaking on Christmas Day, or is he?
Yeah.
That's
you
going to be fun.
listen to him or the king.
Well, and a bucket of KFC because they do like that on Christmas Day over in Japan. So Ueda with a bucket of KFC, just flouting all the tradition. But yes, so we'll have to hear from Ueda and just get another pitch. He's been quite revealing of late in some of the speeches he's made in terms of direction of travel as far as he's concerned and monetary policy for BOJ. We got US Q3 GDP, as we've just discussed, it's likely to be as messy as anything we've seen. Although, let me thinking, if it's going to be the quarter, it's backward looking anyway. But I guess the end part of the collation of that data is going to be a bit messy anyway. If I'm right, or could be right on that one.
Yeah, you are.
Yeah. So again, that's something else we will, I guess, from both of you'll take a glance and look at. But really, you want Q4 data to get any kind of semblance of. Well, even that's going to be a bit messy as well, I guess.
Yeah, I would almost be tempted to ignore the Q4 numbers because we had a 7-week long shutdown. So you're looking at 140, 150 basis points off quarterly growth just from that alone. And then that'll all be recouped in Q1. So actually, you're probably not going to get much signal from US GDP figures until midway through next year.
Wow. It's quite a time to wait for that. Ryan?
Yeah, no, I agree with that as well. Well, that's if we don't get another government shutdown in January, at the end of January.
Yeah, that's true, actually.
Yeah,
and then we might not get any data at all. So, yeah, there's Q3 is probably going to be the last clean bit of data. And then, as you said, Q4 is going to be an absolute nightmare. Even Canada can't put together some of their numbers because they couldn't get any data out of the US. So that's been the knock on. And yeah, well, let's worry about that in January.
Which brings me finally to the forecast for next year. You get a lot of bank research around this time of year on what to look out for the year to come. I've got a Deutsche Bank survey here, and it's their year ahead global outlook which they put out to their customers. What they say is our 2026 year ahead global financial market survey, 440 responses from around the world, and they conducted it between the 12th of December and 17th of December. They've never had such a big leader in the biggest risk stake for the year ahead, which they put at tech values plunge and AI enthusiasm wanes. AI has been the story really for this year, and I guess it's really that's going to lead us by the nose, the markets by the nose for next year. Would that be again your number one lookout out of anything, guys? Mike?
Yeah, I think it probably would be. I mean, I think we're already starting to see it, to be honest. If you look at, certainly in the single stocks, you look at Oracle has been very, very shaky recently. Broadcom obviously had that big lurch lower after their earnings the other week. Nvidia has kind of gone nowhere for 6-8 weeks now. That's clearly the big risk, just because every man and his dog is almost all in on the idea, and the market's kind of priced to perfection, which gives you plenty of room to correct if perfection doesn't pan out. But again, this is sort of a classic economist's answer, but the biggest risk is in reality probably something that we're not even thinking about yet, which is why it's going to be such a risk, because it would come as a bolt from the blue, whether that be geopolitical, political, monetarily, if there's a surprise rate hike or rate cut somewhere. That's probably the real sort of black swan that we should be looking at.
Yeah, Ryan, just quickly, because I know we are going to wrap it up. What are your views for next year in terms of how would you treat the start of the year in terms of your trading and the way you position yourself?
Yeah, well, talking about the AI stuff, I think that the big risk next year is going to be the debt levels in that sector. I mean, what's going on in OpenAI is absolutely bonkers. I know Michael likes pointing out when they borrow money off people to then buy that person's product or that company's product. It's crazy. So I think that is a potential black swan event next year. Otherwise, my view hasn't changed. I still think economies aren't doing great in Europe, except for a couple of outliers. Germany, there's going to be a lot of eyeballs on Germany to see if this infrastructure defence spending is going to kick growth up. I can't see that bringing anything more than maybe a short-term lift. So I still think the ECB could well cut again next year. Bank of England, as we discussed, I can't see the UK economy improving at all. It will be a pretty big shock if it does. So rates heading lower there, I think that's going to keep the pound on the back foot going into next year. I wouldn't be surprised if we're seeing euro sterling pushing up towards 90s at some point. As for the US, we've got, again, as I said, the possible shutdown. We then later in the year got the midterms coming up and all the politics in between. So yeah,
that's going to be quite critical, isn't it? Really,
yeah, exactly.
How we see the next time.
I think they're going to walk a fine line in terms of growth and the economy, and we'll wait and see if they fall off the fence any which way.
Yeah, fair enough. Just quickly on this survey, 57% anticipate turmoil from a new Fed chair, aggressive cuts. 50% foresaw or foresee a crisis in private capital, and other risks include rising bond yields, a US hard landing, and a global trade war. So again, some of the worries there from some of the respondents to that Deutsche Bank 2026 year ahead global market survey. Listen,
well,
guys,
at least we won't be bored next year then.
50%, well, seem quite happy with it then if it was 50% one way.
Yeah.
That is very true. Well seen. Right, listen, guys, I want to wrap it up now. So thank you very much for your participation again.
Yeah,
absolute pleasure. Thank you as always for not just today but throughout the year, and have a very, very Merry Christmas to everyone.
Yeah,
Awesome.
Thanks, mate. Same to all your viewers as well, and listeners. Have a happy Christmas, safe holidays, and a happy New Year.
We'll get you back on in the new year, guys. Always entertaining to have you both on, and very informative. So thank you again.
Mate.
Thanks, mate.
Have a good one. Anyone who missed the start of this episode, you can go back on the social media platforms and listen there, or you can find us on Spotify, Amazon Music, and all the other popular podcast platforms. One more final thank you to my guest Michael Brown of Pepperstone and also Ryan Littlestone of Forex Analytix for participating in today's episode. I'd like to wish everyone a Merry Christmas, Happy New Year, and see you all again in the new year. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.